Welcome to our discussion on a foundational concept in economics: how economic agents make decisions in markets. Understanding these decision-making processes is absolutely fundamental to comprehending how markets function and how economies operate. Economic agents are the key players in any economic system. These include individuals, often grouped into households, firms that produce goods and services, and governments that regulate and provide public goods. Each of these agents plays a distinct yet interconnected role. At the heart of all economic decisions lies the concept of scarcity. Resources are limited, while human wants and needs are virtually unlimited, forcing choices to be made. This fundamental constraint drives every decision an economic agent undertakes. Decisions are also driven by a universal desire to maximize utility. For individuals, this means maximizing satisfaction or well-being. For firms, it translates into maximizing profits or market share. These individual and collective decisions ultimately shape the dynamics of supply and demand within markets. The aggregate choices of consumers and producers determine what is available and what is desired. These supply and demand dynamics, in turn, ultimately determine market prices for goods, services, and resources. Prices act as signals, guiding further decisions by all agents. Finally, these dynamics of decision-making, supply, and demand ultimately determine the allocation of resources throughout the economy. They dictate where labor, capital, and raw materials are employed. Rationality lies at the core of economic decision-making models. It is a simplifying assumption that allows economists to predict and analyze behavior in a structured way. Economic agents are generally assumed to be rational in their choices. This means they systematically weigh available options and choose the one that best achieves their objectives. Rationality, in this context, means aiming for choices that best serve an agent's self-interest. This pursuit of self-interest is not necessarily selfish, but rather goal-oriented. Self-interest does not necessarily imply selfishness or a disregard for others. It simply means that agents act in a way that they perceive will improve their own situation or achieve their specific goals. Rationality implies a consistent pursuit of defined goals. An agent's preferences are stable, and their choices are logically consistent over time, given their information and constraints. For firms, the primary and often singular goal assumed in basic economic models is profit maximization. They strive to produce goods and services in a way that yields the highest possible financial return. For individuals, the primary goal is utility maximization. They seek to make choices that provide them with the greatest possible satisfaction or well-being, given their budget and preferences. Individuals, as consumers, make a wide array of economic decisions. These choices are central to understanding demand in markets. Individuals make decisions regarding consumption, choosing which goods and services to purchase and in what quantities. These choices reflect their preferences and budget constraints. They also make decisions regarding saving, allocating a portion of their current income for future consumption or investment. This involves a trade-off between present and future utility. Furthermore, individuals make decisions regarding labor supply, choosing how many hours to work and in which occupations. This decision balances the utility of leisure against the income earned from work. In making these choices, individuals weigh the costs and benefits of each option. This systematic evaluation is a hallmark of rational decision-making. Several factors are considered when individuals make consumption choices. Among these, price is a crucial determinant, influencing affordability and perceived value. Income is another significant factor, as it directly determines an individual's purchasing power. Higher income generally allows for greater consumption. Personal preferences and tastes play a vital role, as they dictate which goods and services an individual finds most desirable. These preferences are subjective and vary widely. Future expectations also influence current decisions. Anticipations about future income, prices, or economic conditions can alter present consumption and saving patterns. Individuals often employ marginal analysis in their decision-making. This involves evaluating the impact of adding one more unit of an activity or good. Marginal analysis compares the marginal benefit of an additional unit with its marginal cost. A rational individual will continue an activity as long as the marginal benefit exceeds the marginal cost. Consider the example of deciding on an additional slice of pizza. The individual weighs the additional satisfaction or utility gained from that slice against its additional price and the feeling of fullness. Firms, as producers, are another critical type of economic agent. Their decisions drive the supply side of markets. Firms make decisions concerning production levels, determining how much of a good or service to offer to the market. This choice is influenced by costs, demand, and technology. They also make decisions concerning pricing strategies, setting the prices at which their products will be sold. This involves balancing revenue generation with market competitiveness. Furthermore, firms make decisions concerning investment, allocating capital to expand production capacity, develop new products, or improve efficiency. These are long-term strategic choices. Their primary aim, as previously mentioned, is to maximize profits. This objective guides all their operational and strategic decisions. Profit is precisely defined as the difference between total revenue generated from sales and the total costs incurred in production. Firms strive to maximize this positive difference.